Hey everyone! Welcome back to the channel. Today we're diving into a super important concept in finance and business strategy, the cost of capital. If you've ever wondered, how do companies decide whether an investment is worth it? Why some businesses take loans while others issue shares? How do investors decide what return they want? Then this video is for you. This is part 1, where we break down the fundamentals in a simple, story-driven way. No heavy formulas, no complicated spreadsheets, just the essentials. Alright, let's get started. Section 1. What is cost of capital? Imagine you want to start a small business, maybe a cafe. You need money for the shop, for furniture, for the coffee machine, for the staff. Now, you don't have all the cash yourself. So what do? You get the money from other people, maybe a bank or maybe some investors. But here's the catch, money is never free. Everyone who gives you money wants something in return. This something, the required return, is what we call cost of capital. In short, cost of capital equals the minimum return a company must earn to satisfy those who provided the funds. If your cafe earns less than the cost of capital, then the business is actually destroying value. If it earns more, then your cafe is creating value. Section 2. Why cost of capital matters? Let's make this real. Companies use cost of capital to make decisions like, should we build a new factory? Should we open a new branch? Should we buy a competitor? Should we expand internationally? If the expected return on an investment is lower than the cost of capital, gives reject it. If the expected return is higher, gives accept it. This is how corporate finance, startups, and investors think. Example. Imagine your company's cost of capital is 10%. You're thinking about a new project. Expected return 6% gives no thanks, that's too low. Expected return 14% gives go for it. Cost of capital is like a benchmark, the minimum hurdle the project must jump over. Section 3. Where does capital come from? Companies get money from two main sources. 1. Debt, borrowed money. Bank loans, bonds, mortgages. People who lend money expect interest in return. 2. Equity, money from owners and investors. Examples, shares, venture capital. Personal investment from founders. Shareholders expect dividends and growth in the value of their shares. So cost of capital has two main components. Cost of debt, interest required by lenders. Cost of equity, return required by investors. Section 4. Understanding cost of debt. Let's break this down very simply. When a company borrows money, it pays interest. That interest is the cost of debt. But here's something important. Interest payments reduce a company's taxable income. This makes debt cheaper after tax. So cost of debt is basically the interest rate the company pays, adjusted for tax benefits. Why debt might be attractive, cheaper than equity? Doesn't dilute ownership, predictable payments. Why debt might be risky, must be repaid. Too much debt increases financial risk. High-interest debt can get expensive. But overall, investors who lend money expect a safer and lower return compared to shareholders because lenders get paid first if something goes wrong. Section 5. Understanding cost of equity. Equity is more expensive than debt. Why? Because shareholders take more risk. If a company fails, lenders get paid first. Shareholders often get nothing. So shareholders demand a higher return to compensate for this risk. Cost of equity is basically the return investors expect for taking the risk of owning shares. What increases cost of equity? Unstable earnings, high competition, poor economic environment, risky management decisions. What reduces cost of equity? Strong financial performance, consistent dividends, a growing industry, a trusted brand. Investors ask themselves, if I can make 8% in the stock market easily, why should I invest in your company? You must offer me at least the same or more. This expected return equals cost of equity. Section 6. Weighted average cost of capital concept only. Companies don't use only debt or only equity. They use a mix, maybe 40% debt and 60% equity. So they combine these costs to calculate the company's overall cost of capital. This blended rate is called weighted average cost of capital. This is a central number in finance. It's the overall required return a company must meet to satisfy both lenders and shareholders. In the part 2, we will explain how WACC affects valuation, How companies reduce their cost of capital. Practical examples, real business scenarios, and the biggest mistakes people make with this concept. So that's the first half of the topic. If you found this useful, hit the like button, subscribe, and stay tuned for part 2. This is part 2 on cost of capital. In part 1, we broke down what cost of capital is, why it matters, and the basic components, debt, equity, and the blended rate called WACC. Now, we're diving into part 2, where we go deeper into how companies use cost of capital, how they lower it, how it affects value, and how it guides financial decisions. Still no heavy calculations, just practical, real-world explanations. Let's begin. Section 1. How WACC is used in real decisions. Every investment a company makes must pass one test. Will this project earn more than our cost of capital? If yes, gives it creates value. If no, gives it destroys value. Simple example, your company's WACC is 12%. You're considering a new project that will return 15%. 15% greater than 12% gives this project is worth doing. You're earning more than your financing is costing you. If the project only returns 9%, 12% gives not good enough. You'd be losing value. This is exactly how big companies like Apple, Tesla, and Amazon evaluate decisions. Section 2. How cost of capital affects company value. Here's something powerful. Lower cost of capital gives higher company value. Higher cost of capital gives lower company value. Why? Because investors use cost of capital to estimate future cash flows. If the cost of capital is high, they discount future earnings heavily, gives making the company worth less. If the cost of capital is low, future earnings look more valuable, gives increasing valuation. Simple example, imagine two companies earning the same money. Company A has a cost of capital of 8%. Company B has a cost of capital of 15%. Even if their profits are the same, Company A will be valued higher because investors require less return for taking the risk. This is why stable companies with strong credit ratings like big tech firms have lower cost of capital and higher valuations. SECTION 3 Factors that affect cost of capital. 1. Business risk. If a business is volatile or unpredictable, gives investors demand higher returns, gives higher cost of capital. 2. Capital structure. More debt equals cheaper capital, but higher risk. More equity equals safer but more expensive. Companies must balance this carefully. 3. Economic conditions. High interest rates gives cost of debt rises. Recession gives investors demand higher returns, gives cost of equity rises. 4. Company performance. Strong earnings gives lower risk, gives lower cost of capital. Weak financials gives higher risk, gives higher cost of capital. 5. Industry type. Utilities and consumer staples have low cost of capital. Tech startups and airlines have high cost of capital. Section 4. How companies reduce their cost of capital. This is where strategy comes in. Lowering cost of capital increases value instantly. 1. Improving credit rating. Lower risk gives lower interest rates on debt. 2. Maintaining a healthy debt-equity mix. Too much debt increases risk. Too much equity is expensive. Balanced mix keeps WACC low. 3. Increasing operational efficiency. Stable cash flows equals lower risk equals lower cost of equity. 4. Diversifying revenue. More predictable income streams, lower investor-required returns. 5. Strong corporate governance. Transparent, ethical management attracts investors at lower return expectations. 6. Stable dividend policy. Predictability lowers cost of equity. When companies actively manage these factors, their cost of capital drops and valuation rises. Section 5. A cost of capital in mergers and acquisitions. When a company wants to acquire another business, cost of capital becomes a crucial tool. A company with low cost of capital can afford to buy competitors cheaply because it can borrow at lower interest rates. Investors are satisfied with lower returns. Its valuation is higher. This gives it a competitive advantage. That's why giant corporations can keep buying smaller ones. They can raise money more easily and more cheaply. Section 6. Common misconceptions about cost of capital. Lower debt always means safer. Not always. Too little debt raises cost of capital because equity is expensive. Cost of equity is the dividend rate. No, it includes share price growth expectations. WACC stays constant. It changes when interest rates change, the stock market changes, or business risk changes. More profit means higher value. Not necessarily. It must exceed cost of capital. Alright, let's wrap up what we learned today. Lower cost of capital equals higher value. Higher cost of capital equals lower value. Companies can reduce it by improving performance, managing risk, optimizing their debt-equity mix, and earning investor trust. If you enjoyed this video, make sure to like, share, and subscribe for more business and finance breakdowns in simple language. Thanks for watching, and I'll see you in the next video.